I'm Greg Hunter. Welcome to USAWatchdog.com. With us, a guest we haven't had on in a little while. I've had some technical problems, but we do have him on now. It's John Williams, economist. John Williams at shadowstats.com. I call it the real numbers, the real data. John Williams, thank you for joining us from California.
Thank you for having me, Greg.
John, I just want to start off with an email I got yesterday, and it was somebody writing me and saying that, could you bring on people with more moderate views? And I thought to myself, but listen, the truth is not moderate or extreme or whatever. The truth is the truth. And, the truth of the matter is that things are looking horrible, dreadful. And I wanted to start with your numbers about the trade deficit widening and the worst since 2007. Isn't that just yet another terrible piece of data that says the economy is slowing down and doing terrible?
It is, and let me just give a little background to that. We now have 2 months reported for the third quarter of 2015 on the trade deficit. Tends to lag the other numbers by about a month. And usually with the initial estimate of the GDP in a quarter, they would only use 2 months of data. But it's a very important component of the GDP, enough so that it can swing plus or minus a full percentage point of the cumulative of the aggregate GDP growth rate. It added that the headline GDP is up 3.7% in the second quarter, which I believe to be nonsense, and I can tell you why in a minute. Of that, 0.2% came from effectively a neutral trade report. Based on what we have now for July and August, that's going to swing 0.7% the other way, so it's going to be subtracting about 0.5% from the GDP growth as it stands now, and I think it'll actually be worse than that when we get the number in, the final number in for the quarter. But based on those 2 months, we're looking at, this is now an inflation-adjusted merchandise trade deficit, the worst level since before the economic collapse from 2007 into 2009. That's not a good sign, and the relative change is what works its way into the GDP growth rate. What we're seeing here is a net deterioration for the third quarter. I think it's going to be worse than people are even looking at, and on an ongoing basis, it's going to continue to deteriorate. We had some distorting factors that have worked themselves out of the system.
And do you think that this is just a one-off, or do you think this is part of your, when you've been saying that we started off the 2015, it was a bad year, started off bad, they revised it up, but I don't know if you believe the revisions, but you've been saying that 2015 was going to start slowing down, and is this part of the more of your, what you've been projecting, and the more of the slowdown scenario going in here in the last quarter of the year?
Yeah, it is. Let me put it this way. I'll contend that we're in a new recession that will gain recognition as a new recession, official recession, likely to be timed from December of 2014. Now that you're not hearing too much of that, although increasingly people are beginning to raise concerns about inflation. The downturn in 2007 wasn't recognized until the end of 2008. I think by the end of this year, you're going to be people will have recognized that the economy turned down in December, and I'll tell you why I say that. There are a couple of very solid leading or coincident indicators with the broad economy. One is industrial production. Industrial production contracted in both the first and second quarter of these years. Those are the official numbers out of the Federal Reserve. Expectations for upcoming reporting on industrial production are for continued contraction. Industrial production used to be the GDP measure. Now we have a very heavily services-oriented economy, but still underlying production is a very key component of the GDP, and it's contracting quarter to quarter. Retail sales contracted in the first quarter, it's adjusted for inflation. Year-over-year growth has dropped to levels that you only see in recession. Same thing again with industrial production. Same thing with new orders for durable good. All these factors are signaling that the economy has turned down anew, and that's in terms of where they time it. The National Bureau of Economic Research is the official arbiter of whether or not we're in a recession. They use industrial production as one of their timing indicators. Now you look at employment. That's another one. Employment's been relatively strong, but guess what? The Bureau of Labor Statistics in the last month announced that indeed they've been overstating payroll jobs growth. They're going to have a benchmark revision in February that will reduce the level of payrolls in the prior year. They're estimating that March of 2015 was overstated by 208,000 jobs. Now that's their benchmark month, but they adjust that back in time and forward to what will be the next benchmark month of March of 2016.
But aren't a lot of those jobs part-time jobs? Don't they count part-time, 29-hour-a-week and less jobs as, you're employed?
Yes. The payroll employment, the headline payroll employment, and that's probably the number that moves the markets more than anything else, is the number of jobs, number of paychecks being written. So that if someone has 3 part-time jobs because he can't get a full-time job, he gets counted 3 times. There are 2 surveys that are put out by the Bureau of Labor Statistics. The payroll survey is called the Establishment Survey, that they survey firms as to what their payrolls are. The household survey, they go around and survey roughly 60,000 households every month and ask questions as to who's employed and not employed, and a tremendous list of questions. But one of the issues that comes out of that is that they have a count of full-time employment. Now, in terms of the payroll employment, you recovered the pre-recession high number of jobs back in 2014, and you're maybe 9-10% above that right now. In terms of full-time employment, the series is just playing with recovering its pre-recession high. The growth in jobs has been largely in part-time jobs. People, and often for economic reasons, where people can't get, they want full-time employment, but they can't get full-time employment. So that's not a good sign. And again, you look at the headline unemployment number, which is artificially low versus common experience because of the way it's defined. And to be counted as headline unemployed, you have to have been actively looking for work in the last 4 weeks. But if you have a circumstance where you can't find a job and you're a long time unemployed and you give up looking for work because there are no jobs to be had, but you're still unemployed, you want to work, you're not counted in the headline unemployment. So that you look at this last unemployment rate they published at 5.1%. Two big issues with that. One, that included a drop of 350,000 people in the labor force. And about half of that were people who were unemployed. They just disappeared from the counting. They also had a drop in the number of employed, but overall the labor force declined. And if you have people disappearing from the labor force because they're being redefined out of the headline unemployment, that lowers the headline unemployment rate. The second thing is that the government uses what they call concurrent seasonal adjustments to these numbers. Every month they recalculate their seasonal adjustments to adjust for regular seasonal variations. But in doing that, they also restate the history going back in time month after month after month. And there's nothing wrong with that. I don't think it's a particularly good process in the current environment. This is all designed before you had the great crash in the economy. But if you look at what they're doing now, they do not publish They'll give you the current unemployment rate, but they won't tell you what the prior month's actual unemployment rate is now, as it's been revised with the recasting of the seasonal factors to come up with a new headline number. So that when they say the unemployment rate drops by 1% or is up by, it drops by 0.1% or is up by 0.1%, that has no meaning. You don't know whether it's up or down because you don't know what they did to the month before, and they don't publish the prior month's number because they don't want to confuse people. But the numbers they're giving you are just worthless month to month.
So the picture you're painting is that GDP is slowing down, trade deficit is widening, the jobs are mostly part-time, and the numbers are, I think your point, garbage, or not very good numbers. So the picture is the economy is slowing down. The global economy is slowing down. What do you think the next move is for the Fed? Are they going to be raising rates?
They need to raise rates, but if they're going to wait until they have strong economic numbers, I don't think that's going to happen for a number of years. Let me just make one last point on the GDP, because indeed you're right. Everything is slowing down, and I think a lot of people are recognizing this. Increasingly, you're getting some talk of recession. You have the GDP can be used to define a recession. 2 quarter-to-quarter contractions that'll for sure give you a recession. But they also have a series that's published with the GDP that is its equivalent. It's called the gross domestic income. There are two sides to the equation. It's like double entry bookkeeping. On one side, you have the income accounts, which is the gross domestic income. On the other side, you have the consumption accounts, the gross domestic product. And the two have to equal each other. They make them equal each other by adding a statistical discrepancy to one account or the other. Usually they add it to the gross domestic income. But if you look at the growth in the gross domestic income, which is, as far as I'm concerned, probably a better number at this point because it doesn't get played with as much. It's not as politically as sensitive a number. It's been flat for the first half of the year. There's no growth. And that's what we're seeing. That's basically consistent with what you're seeing with the industrial production and the retail sales. It's showing effectively a recession because the GDP has other factors built into it to keep it on the plus side. But when you go flat on the GDP or the GDI, that doesn't happen without being in a recession. And maybe you have 2 quarters there, you're flat. Again, the GDI is confirming what I'm looking at, and that's effectively the GDP.
So what do you think the next move of the Fed is? What do you think they're going to do? What do you think the powers are going to do?
I think the Fed's lost control of the system. I don't know quite what they're going to do, but I think they're not able to do what they want to do. They'd like to raise interest rates. They had an opportunity back in June where the economic numbers temporarily supported them. This last time around, they announced, rather formally through different people that there's definitely going to be an interest rate increase in September, irrespective of the economic numbers, but that didn't happen. And the markets began to move around and say, oh, this is, the economy's too weak, they're not going to do it. And the market expectations came around to the point that, no, they're not going to raise rates, and they didn't raise rates. There's some real problems there. First of all, the economy has very little to do with what the Fed is looking to do. That's a canard. You go back to 2008. We had a system in crisis and crash. The financial system was on the brink of collapse. I mean, no question. I mean, I think most people recognize that. People like to forget it, but we've never recovered from that. The Fed, the federal government, did everything they could to prevent the system from collapsing, and including with the Fed and as well as the Treasury, creating whatever money they had to create, supporting whatever companies needed to be supported, making whatever guarantees were needed on accounts. Everything they had to do to keep the system afloat, they did. And they kept the system afloat, but they didn't do anything that fundamentally addressed the problems that got us there. So the economy is still in trouble. The banking system is still shaky. The federal deficit's still there, and the long-term solvency issues for the United States are still in place. None of the big issues were addressed. But what the Fed did, and you have to keep in mind that despite and they talk about their official mandate, to keep employment up and keep inflation low, but the Fed's primary function always has been to keep the banking system afloat. The banking system fails, you don't have to worry about the other factors because they're not going to be issues. You'll have a 1930 style employment crash, whatever. It's they will not let the system fail. So what the Fed did with its quantitative easing was it said, "Oh, we're doing this to stimulate the economy." Well, that's nonsense. And they knew there was very little they could do to stimulate the economy. All the cash that they created, the treasuries that they bought from the banks, cash for the banks put the cash back with the Federal Reserve and deposited it there as excess reserves, and the Fed pays them interest on that money, still is. And if the Fed raises rates, they're going to be paying them more money on those reserves that are being held there. This is effectively free money for the banks. Now, if they wanted to stimulate the economy, what they had to do was to get the banks to lend the money into the flow of commerce. And then the money supply would have grown. People would have had money to expand their businesses, whatever. You haven't had that. So that all this quantitative easing that we've seen in place was aimed at as effectively a covert bailout of the banking system.
Ben Bernanke says it was to create jobs. I mean, that's not true, is it? That's not true.
No, the weak economy was used as political cover. It's still being used as political cover. And guess what? Wall Street began to believe it. The stocks will rise or fall depending on what's happening on the economy, because that's what Wall Street is reading is driving the Fed's decision. The Fed needs to raise rates. They didn't raise rates. They could have, but I think the reason they didn't is that there's something else going on in the system, something that really has them scared. And this is an aftershock still of the panic in 2008. I don't know if you have major weakness in a major bank or new stresses in the financial system. Something is amiss. The Fed should have raised the rates. They know they should have raised the rates. They know it would not have hurt the economy. They're very concerned about something.
What do you think their next move? Well, obviously they're concerned about the economy slowing down because they must know what you know. They employ hundreds of economists, and they actually have the real data. So they know that the economy is slowing down. So what do you suppose? You've been calling for a hyperinflation, them to start QE4. There's talk of negative interest rates. There's also talk of raising rates, and Christine Lagarde is making public statements to Janet Yellen, don't raise rates. What do you suppose they're going to do? What do you think their next move is?
Their next move, I'm afraid, is going to be more towards quantitative easing, debasing the currency. That was their initial reaction. We're seeing ghosts of 2008 resurfacing here that are going to have to be fought. I think they're going to go towards a QE4. All of that's going to tend to hit the dollar. And guess what? We're in an environment that's a really quite a dangerous circumstance now. Because China's economy is in trouble, and you're seeing a number of large holders of the U.S. debt starting to sell it because they need to raise cash. The biggest buyer we had, we're very close to it in the last couple of years of the treasuries, was the Fed. They kept the rates down. They effectively monetized 3/4 of the net new borrowing of the treasury, and all that is bad for inflation. There's a point here where the dollar is going to take a tumble. You see, when those employment numbers came out and they were weaker than expected, you saw weakness in the dollar. some strength in gold, strength in oil. Now, the reason you saw that was you still have this knee-jerk reaction in the markets that weak economy means the Fed's not going to tighten up, they're going to be looser, and that's going to hurt the dollar. All the strength that you've seen in the dollar in the, last, it's over a year now, mid-year of last year is when they took actions to strengthen the dollar and hit oil prices at that time largely, I think, as a way of covert financial action against Russia and the situation in Ukraine. But where the markets picked up on the dollar strength, people tried to justify it. All the issue about the Fed's tightening, raising interest rates, was used as a foil to try and prop the dollar. The traditional action by the Federal Reserve banks or central banks to support a currency would be to raise interest rates relative to the rest of the world. We had a circumstance like that back in 1987 when you had a new Fed chairman, Alan Greenspan. The dollar was weak. What did he do? Well, he raised interest rates in September, and the market crashed in October. And he was given some credit for the crash because he raised interest rates, and I'm sure that's sitting in Janet Yellen's mind as well. They don't want to see the market crash, and there's some legitimate fear there, but they have to raise rates. The system's not stable. You have to get off the zero interest rate that they have.
So they're damned if they do, and they're damned if they don't.
Yeah, they never stabilize the system. They never resolve the issues of the panic. They bought time. They kicked everything into the future. We're in the future, and the problems are surfacing. I can't tell you exactly how they're going to respond, but they're going to do whatever they can to keep the system afloat. That's generally going to need more cash, more flooding of liquidity into the system, which will be inflationary and which will be debasing in nature to the U.S. dollar.
Ben Bernanke, for years, I've been saying that, and I've had guests on saying, and William Black, who's an expert in white-collar crime, Professor Black, UMKC, also a former regulator, RTC regulator, top regulator. Also, he's a professor of economics, professor of law, top expert on white-collar crime. And he said this a couple of years ago, we have felons running our top financial institutions. And Ben Bernanke's out with a new book, and he's out, and guess what? He backed that up. He said that more bankers should have been jailed for causing the 2008 crash. Of course, he bailed them all out, and now Lloyd Blankfein's a millionaire. So here's my next question. You've been calling for hyperinflation in 2014. You pushed it off into 2015. Has all this fraud distorted your predictions, and because a lot of people have missed this and never in their wildest dreams would have thought we'd have LIBOR rigging and Forex rigging and the gold market rigging and futures rigging and mortgage rigging and just we have a fraudulent economy. Has that been a reason why that you have been missing and other people have been missing their forecast for a crash or hyperinflation or whatever?
Well, the rigging is not a surprise. I mean, you almost have to expect that again. They'll do anything needed to keep the system afloat. You're talking the end of their system if they don't. On the other hand, they've been much more successful for much longer than I would have expected in terms of keeping things afloat, and that is what has caused me to have to push my forecasts back.
They did some real fraud. I mean, huge.
Well,
I'm laughing, but it's not funny. I mean, it's a huge fraud.
It is, and there are elements that continue. I mean, for example, been very clear efforts at knocking down the price of gold. Direct intervention. Nobody intervenes in the market to knock down the price of gold and for personal profit. I mean, maybe they'll play that with positions, but the amount that was done there suggested something on the order of a magnitude of a central bank being involved. Very clearly it was manipulated, and if it were not central banks, you should have regulators looking into prosecuting those people who were manipulating the gold market. That's, I mean, the central banks don't want gold to be strong. Strength in gold indicates they're not doing their job. It's a traditional flight to safety, a traditional flight from central bank incompetence or a gross misconduct, which we've seen. And so if they can discourage people owning gold, if they can batter gold's image, all the better from their standpoint politically. It'll make maybe people put more money into the stock market, which you're hoping will help prop up the broad economy, as opposed to really looking for long-term preservation of their assets. My general long-term outlook hasn't changed here. The dollar faces ultimate debasement in a reasonably short period of time.
Do you think that happens this year, or are you going to...
Well, we're coming towards the end of 2015 now. It's I mean it may, obviously it could be in 2016. I don't know, maybe even a little later than that if this goes on much longer. I just don't see this continuing much longer than it has. And the key here remains the value of the dollar. We see the rest of the world move against the dollar, everything will follow quickly with that. And that could happen anytime. Weakness in the economy, bad actions by the Fed, new problems in the banking system. We have the weakness in the economy. It's gaining much broader recognition. You're going to hear more and more talk about looming recession. My contention is this is not a new recession. My contention remains that the economy never really recovered from the crash into 2008, 2009. The economy. If you look at the official version of it, the economy crashes and then it rebounds, and we're stronger now than we ever were. That's nonsense. What a lot of statistics show is that the economy crashed and then maybe had a little bit of a bounce up, but generally it's been stagnant at a low level since. The downturn that we're getting now is a new downturn, but it's still part of the broad picture of what happened in the late decade that started this century. It is when the final books are written on this, I think you'll see that we've been through something that will parallel the Great Depression. I mean, that's in terms of length, and eventually in terms of depth. We're not there yet in terms of official depth, but this is not a happy time. It doesn't have a happy ending. We're not going to see an economic rebound in the next year or two. This is going to take decades to work out, and you have to recognize the problem before you start to respond to it. This is we've discussed this before, but a very important thing here is that Main Street USA has a pretty good sense of what's going on. I'll take Main Street USA, what people think they're saying in the way of the economy, inflation, any day over the numbers out of Washington. I know what they do to the numbers in Washington. Circumstances are so bad that you're saying something here which we've had sense of before, but it looks like it could really be significant this time around, and that is throw the bums out. You're getting non-traditional candidates leading in early polls, and these are people who are willing to address the big issues and raise a question. Hey, what's going on here? The economy really isn't recovered. Unemployment's not 5%. Look at what's happening here. Look at what's happening there. The Americans, an average guy is not doing well. He knows he's not doing well. He sees the government's lying to him in terms of the economic statistics. And this is a time where you could have a significant shift in the political spectrum.
John Williams, shadowstats.com. John Williams, thanks for joining us today on USAWatchdog.com.
Thank you for having me.